In this video, I'm going to walk you through exactly how to start investing in futures and options using Robinhood. Whether you're a complete beginner or just looking to understand how these trades actually work, this step-by-step tutorial will break everything down. From contract pricing and expiration to how to place and manage your trades inside Robinhood. Let's begin with a quick overview of what futures contracts are. Futures are derivative contracts that allow you to speculate on the future price of an asset. You can trade a wide range of assets such as index funds like the S&P 500 or NASDAQ, currencies or Bitcoin futures, similar to Forex trading, or even commodities like crude oil and gold. Keep in mind that futures contracts are leveraged derivatives, meaning you can control a large position with a smaller amount of capital. This leverage amplifies both potential profits and losses, making futures trading riskier than trading the underlying assets directly. There are several reasons traders prefer futures over stocks or options. First, there's no pattern day trader rule. You can open and close unlimited trades daily without maintaining a $25,000 account balance. Second, flexibility. Futures make it easy to go long or short, unlike shorting stocks, which can be complex and costly. Third, leverage. You can control larger positions with less capital, though this also increases risk. Fourth, tax advantages. Futures follow the 60-40 rule, where 60% of gains are taxed as long-term and 40% as short-term capital gains. Consult a tax professional for personal advice. Fifth, extended trading hours. You can trade nearly 23 hours a day from Sunday to Friday, giving access to global market movements. Sixth, exemption from wash sale rules, which benefits active traders. Seventh, mark-to-market accounting, which can simplify reporting for frequent traders. Eighth, no Greeks. Unlike options, futures are based purely on price movement, making them more straightforward. Now, let's quickly talk about fees and commissions. Robinhood's fee schedule for futures trading is competitive, often at or below the market average. They charge 75 cents per contract traded for non-gold members, and that rate drops to 50 cents per contract if you have Robinhood Gold. There's also a small NFA regulatory fee of 2 cents per contract, plus a variable cost depending on the specific contract type. For index futures, for example, this additional fee is typically around 35 cents per contract, but it can vary, so always check the current rates before you trade. Altogether, you can expect to pay between 87 cents and $1.12 per contract, and that fee applies both when you open and when you close your trade. So, double that to estimate your total round-trip cost per trade. After enabling futures, go to the search bar and type Futures. Scroll to the bottom and select the Futures option in the list. This will show you the full list of available contracts, currently around 41, including index, crypto, and energy futures. You can browse through them and click the plus icon next to any you want to add to your watch list for easier access later. Now, let's look at the contract specs, expiration, and stats. This is important to understand before placing a trade. For example, take the Micro E-mini S&P 500 futures contract, a smaller version of the standard E-mini contract. Scroll down to the contract specs section. You'll see details like margin requirement, leverage, tick size, tick value, and multiplier. The margin requirement is key. It tells you the minimum amount needed in your account to open one contract. At the moment, it's around $2,343.90, but it's recommended to have more than that to avoid a margin call. A margin call occurs if your balance drops below the requirement, and Robinhood may close your position to cover losses. Think of margin as your capital contribution to control a larger position. Next is leverage. Here, it's about 14.57x. That means you're controlling roughly 13 times the value of your margin. So with a $2,350 margin and 14x leverage, you're effectively controlling around $30,000 worth of S&P 500 exposure. Then there's the tick size, the smallest possible price movement for that contract. For this one, it's 0.25 points, though it varies by contract. The tick value shows how much your profit or loss changes per tick, which in this case is $1.25. The multiplier, here $5, indicates that every full 1-point move in the index changes your contract's value by $5. These three, tick size, tick value, and multiplier, work together to show how each price movement affects your profit or loss. The contract's price movement in dollar terms is straightforward. For example, if the contract is priced at $6,300 and it moves to $6,301, that represents a $5 move per contract. Trading hours are the same for all futures contracts, 23 hours a day, 5 days a week, from Sunday at 3 p.m. to Friday at 2 p.m. Futures close for 1 hour each weekday between 2 p.m. and 3 p.m. for maintenance. The settlement type for these contracts is cash, meaning you're not taking physical delivery of the underlying asset. All profits and losses are settled in your account as cash. The final day to trade this particular contract, which marks its expiration date. You'll need to either close your position or roll it over to a later contract before that date. If you look at the small drop-down above the futures contract name, you'll see which specific contract you're trading. As the expiration date approaches, you can roll your position into the next contract or simply close it out and switch to the newer expiration. Be aware that rolling a contract over does involve fees, so it's worth researching that process before doing it. If you scroll further down, you'll notice a section labeled Stats. This updates in real time and provides more details about the contract you're trading. It shows the current bid and ask prices, the high and low of the day, total traded volume, and the previous settlement price. Now, let's go over how to place a trade. To execute a futures trade on Robinhood's desktop platform, go to the top left corner of the screen and choose whether you want to buy or sell, depending on whether you plan to go long or short. Next, select your order type, limit, market, or stop order. If you're placing a limit or stop order, set your desired price and enter the quantity. For this example, we'll use 1 contract. You can also decide if your order should be good for day or good till cancelled. On the right-hand side, you'll see the estimated buying power effect, which shows how much money you're committing to hold the contract. It also lists commissions and fees. In this example, the total cost shown is 0.87 since I have Robinhood Gold. Clicking the drop-down reveals a detailed fee breakdown, 50 cents in commission and 37 cents in regulatory and exchange fees. Remember, these fees apply per contract each time you buy or sell. So when you both open and close the trade, you'll pay those fees twice. In this case, 87 cents times 2 equals 174 total in fees per contract traded. After reviewing your order, click Review Order, and then either Buy to execute or Edit if you want to make changes before confirming. Robinhood also sends daily and monthly futures statements that summarize all your trades, including profit and loss, fees, and contracts traded. These can be found under Reports and Statements in your account settings. If you use TradingView for charting, be aware that the free plan has about a 10-minute delay for futures price data. For real-time data, which is crucial when trading futures, you'll need a paid plan that includes CME Group's live data feed. Finally, a quick but important reminder. Futures trading involves substantial risk due to leverage, which can magnify both profits and losses. Always use proper risk management and never trade with money you can't afford to lose. I recently found a really high-quality stock-picking newsletter that I think you'll like. It's written by professional money managers who handle hundreds of millions of dollars for their clients, and they focus on something called asymmetric investing. Basically, they look for stocks that are boring, the kind most people ignore, but that quietly make a ton of money and have really strong fundamentals. This strategy helps you avoid the overpriced, overhyped names everyone's talking about, and instead build wealth from companies that actually perform. You can try the newsletter for 30 days for just $1 using the link in the description below. Definitely worth checking out.